Whether you know him as Joseph Carlson or Joseph Moneybags, there's no denial that Joseph Carlson is one of the most polarizing figures in the investing community today. He promotes a great style of investing with finding high-quality companies to invest in that over time grow their business and reward you as a shareholder through buybacks or juicy dividends. I will be going over every single holding in his passive income portfolio. I'll share what companies that I really like, what companies that I don't like, and at the end of the video, I'll share my overall grade on his portfolio and rate it on a scale of 1 to 10. Lastly, thank you to Joseph for allowing me to go over his portfolio. Thank you for the permission. And of course, roll the intro.
Hello, I like money.
Alright, to start off, let's go over his portfolio performance. Over the last 1 year, he is up 12.82%, which is beating the S&P 500 by a little bit, by around 1%. And over the last 5 years, his portfolio is up 131.97%, which over doubles the S&P 500 62% return over the last 5 years. So Joseph's outperforming the market right now. But what companies did he buy to get these gains? Alright, let's go over the portfolio overview real quick before we get into the holdings. He currently has 14 holdings, which I view as very optimal. He has a current dividend yield on the portfolio of 1.53%, which compared to a lot of other dividend portfolios is really low. As we'll get into though, a lot of these companies are more growth oriented and dividend growth oriented, so I'm definitely not complaining with the dividend yield there. I think dividend yield really is an overlooked metric by a lot of investors. They think that's a great way to value or find the value for every dollar that you're putting into companies. Also, Joseph does have a lot of companies that he bought a while ago. I'm sure his yield on cost is solid too. Moving on to the actual holdings themselves, he has 28% of his portfolio in financials, 24% in tech, 14% in real estate, 12% of the portfolio in restaurants, 11% in industrials, and 11% in consumer discretionary. I like the heavy diversification and the heavy allocation into financials. I think financials are really just an industry that's very monopolistic kind, very hard to compete with, high barrier to entry, and I really am a fan of investing in it. Now, I don't see any utilities in here, which is interesting, which is kind of a question that I have for Joe himself. Is his overall thought on utilities, why you don't own any. I think there was utility that he could add to his portfolio. I think it would be NextEra Energy. That's the highest grower. I think it has solid dividend yield, really quality dividend growth, and growth as well financially. Alright, let's go over the biggest part of his portfolio, which is the financial sector. Now, his biggest holding in this, with 50% allocation, is S&P Global, stock ticker SPGI. S&P Global is a company that everybody has been raving about in the Discord community and has really been known for its monopolistic type features. If I'm being completely honest, I don't completely understand the business model quite yet and how it works. I haven't dug deep into a whole lot of research, and I'm not going to sit here and act like I completely understand the business. But looking at the company's financials, they are very financially sound. They have solid cash flow growth, they do share buybacks over the long term, and they also pay a nice growing dividend. From what I understand, they collect royalties on big ETFs and also have a credit scoring business. I don't own any S&P Global right now, simply because I don't fully understand the business. I'm not going to sit here and act like I do. I believe in transparency, guys. I'm not going to sit here and just act like I completely understand the business. But looking financially, they look like a very high quality business with a company that I'm interested to learn more about in the future. From what I see, they're a monopoly with a huge moat. Going on to a company I understand a lot more about, which is of course MasterCard. MasterCard is in a duopoly with Visa right now in the payment processing industry. Now, you think MasterCard would get their money off of credit card fees, or a lot of people think that at least. Which is a friendly reminder to join the Discord link in the description to talk about credit card companies and how they actually run. But in all seriousness, MasterCard is in a duopoly right now with Visa. They basically run the payment processing network. Very high barrier to entry, very monopolistic features. MasterCard and Visa are pretty much identical. I just go with Visa simply because of the higher network they have. I definitely like MasterCard though, and I approve of the position. Next, he's got Intuit. And I think Intuit will always be stable, as people are always going to be looking to file taxes. I think Intuit's a strong company as well. Their financials look solid, but again, I just don't understand the business fully. I need to do a deeper dive if I were to consider adding to my portfolio. With that said, I do like the way that their business model is ran. Typically, from at least, American and overall the citizens' perspective, people don't like filing taxes. They're not a huge fan of these tax companies, but they're always going to be needed. Moving on to his technology sector, he only has 2 positions in this, which are pretty much the same as mine, and it comes to tech, and that's of course Apple and Microsoft. Now, let's start off with Apple. Apple is in no doubt one of the highest quality companies in the world right now. They're the largest company in the world. I think Apple's biggest thing is really their innovation. Just when you think Apple can't make a new product, they make a new product. I was really impressed with the new iOS updates, the wallpaper updates that they had last fall, and I think this VR headset will be the start of something special with Apple. I think that they're starting with the VR headsets and they're eventually going to make it cheaper and more affordable to the everyday person. I think Apple has multiple business segments that they could dominate in the next 50 years. Apple has so much potential in so many different segments. I think their healthcare segment with their Apple Watches and glucose monitoring has huge potential. I think they have huge potential in fintech. I think if they ever make a car that has so much potential. And I think really Apple deserves to be trading 25 plus forward PE. Apple has been on a run recently too, trading near $200. I remember just a few months ago, I was buying it in the 130s and 140s. It is truly rewarding getting a company that you were believing in and buying on the dip or a significant decline, and when the price goes up and everybody wants to buy it, you're in those gains. It's one of the best feelings as an investor. If you couldn't tell already, I love Apple as a company. I own a lot of Apple right now in my portfolio, but I do think it's a hold. I think long term though, Apple is a great buy. Next, Joseph owns the highest quality company in the world and one of my favorite companies, which is of course Microsoft, stock ticker MSFT. Microsoft dominates the cloud right now. Microsoft has a lot of monopolistic features. It's a giant and it's expanding its business segments and diversifying its business. Microsoft has been on a run recently too, trading in the 300s as it was just trading near 220 and 230 just a few months ago. I was also buying the dip on this one. It again is so rewarding to see. I'm a big bull on Microsoft mainly because of their gaming business. I think they have a lot of potential with that, considering the Activision Blizzard deal was approved in the US. Unfortunately, the stupid little AI bull run that we've had has really impacted Microsoft's stock price positively. They're trading up a lot now, and it looks like it's going to be hard to find a dip in the mid 200s again. Thankfully, I loaded up on Microsoft when it was trading at low levels, and it is a core position of my portfolio and the largest stock that I own in my portfolio right now, sitting at around 10.5% of the portfolio. If you couldn't tell, I love Microsoft so much. As for buying Microsoft, I think it is a buy long term. If you're really looking to add to the position, I think it's fair priced under $300. For me though, since I already have a huge position built up, if it starts to dip into the 270s, 260s, I will definitely be adding. I love Microsoft. They reward me as a shareholder through generous dividend payments, increases, and share buybacks. So I definitely approve of these two positions. Next, for Joseph's real estate holdings, he has Vici, the Las Vegas-based REIT. Vici was originally really condensed in Las Vegas with a bunch of properties in the Las Vegas Strip. Since then, they've diversified across North America. If you want to learn really deep about Vici, I made a stock review video. You can check that out in the top right corner or link in the description. For me, the two REITs that I own right now are Realty Income and Vici, and I have a little bit more than Realty Income, but both are pretty sizable positions. Overall, I think real estate and REITs are a great hedge against inflation. They offer a great dividend yield for both. I think, though, the appeal with Vici is there's a lot more growth potential compared to Realty Income, which is kind of underperformed a little bit. Realty Income is definitely more of a staple, and if we were to ever head into a recession or really tough economic time, I think Realty Income is way more likely than Vici to come out on the other side undamaged. With that said, I do think both companies, if we were to go into a recession, would be fine at the end of it. I just think, though, Realty Income is way more of a staple. They have a lot more different tenant and tenant diversification than Vici. With that said, though, Vici does have some really high-quality properties across the world. With that said, though, I think Vici is a much better play for dividend growth compared to a company like Realty Income, which is way more conservative when it comes to the growth side. I do think both REITs are great, though, and I approve of this position for sure. Moving on to Joe's restaurant holdings, he's Texas Roadhouse is 60% of the restaurant holdings, and the other 40% in Starbucks. Now, you guys know how I feel about Starbucks on this channel. It is arguably one of my favorite companies in the world, and I own a good amount of it. Starbucks is one of the best brands in the entire world and one of the most recognized brands in the entire world. I think the simple size of Starbucks and how scalable they are, how much capital expenditure they can have, how many restaurants they can build, gives them a huge competitive advantage to your local mom and pop coffee shop or other chains. As Starbucks is a bit of a luxury item, I do think if we were to go into a recession, Starbucks probably wouldn't be the greatest company to hold, but I think long term it's an amazing company. Starbucks has great profitability, great pricing power as they displayed last year, and has an amazing reward system that lets them act as a bank and basically take out interest-free loans. If you guys would like me to make a video on that, let me know in the comments. Moving on to Texas Roadhouse as a holding, I actually talked about Texas Roadhouse in the most recent video, but I do like them as a company and I'm looking to add it to my portfolio. With that said, if they continue dipping, maybe if they hit 105 or 106, I would likely add to my portfolio and continue to dollar cost average as the price goes lower. It's a company that I've realized there's high demand for it right now. I like them as a business too. They reward shareholders through good share buybacks and nice dividend growth and dividend payments. They also perform very well during recessions compared to some other restaurants that don't. They sell juicy steaks and have really good customer service. What else can I say? I like Texas Roadhouse, and don't be surprised if you see me at 105 or 106.
And hey, you, right there, do you want me to go over one of your portfolios? Join the Discord link in the description and message me from there. On to the video.
Moving on to its industrial holding, it's two railway giants, which is Union Pacific and Canadian Pacific, both great railway companies. The railway industry is very high barrier to entry, very hard to compete. And let's be honest, guys, how much money are you gonna need to build a completely new railway across the United States? How much debt would you hit? It's very high barrier to entry, which is why these companies are so favorable right now. I own Union Pacific over Canadian Pacific. The main reason, I think Union Pacific is more fairly valued. Also, some of Canadian Pacific's financials kind of, confuse me straight up. Their dividend history is a little skewed. Union Pacific also just hired Jim Vena as their new CEO. He was called out by Suburban Capital to be the new CEO after they called out Lance Fritz and other management for bad business execution, performance, and shareholder returns relative to other railway companies. And Union Pacific's financials already look really good as is, so it's kind of crazy to think that they can improve even more. The railway industry is an industry that I really want to study more on this year. It's a very monopolistic industry, high barrier to entry, very hard to compete with. I definitely approve of these two positions. I think a company that Joseph could add into the industrials, though, is Waste Management. Financially, it fits his criteria. Very monopolistic business with a recession-proof business model. And moving on to the last part of his portfolio, which is the consumer discretionary. To start off, 63% of it is in one of his favorite holdings, which is Costco, stock ticker COST. Costco is a company that has historically traded at a really high valuation and outperformed the market. Costco pays a nice growing dividend with occasional special dividends. Costco's unique business model, their brand value, and I think the moat that they have makes them a really appealing company to own. Now, I have added some Costco recently, but I've stopped the buying as it has traded up a lot in price recently, and I've gotten a lot of flack because of the valuation at Costco. And here's the thing. I'm buying these companies to hold for 40 plus years. Ideally, I'm just going to hold them forever and let my dividends do their thing and compound interest do its work. With that said, Charlie Munger said that if you're going to be buying this stock for long term, 30, 40 years, it's a buy now at this valuation. Another thing to keep in mind with Costco is their PE historically trades at a really high price. Why would I want to wait on the sidelines when the PE is always high and just lose out in capital gains, my dividends reinvesting, etc.? I think it's dumb to wait on the sidelines with a really high quality company like this. With that said, though, valuation does matter. They've traded up a lot recently in the last few weeks, so I'm going to see where it kind of averages out. If it averages out around here, I'll continue my dollar cost averaging of $25 a week. Right now, Costco's a really small position in my portfolio, but I would love to build it up. I had never been to a Costco until around a year ago, and I was really impressed by the experience. Next, he's got Estee Lauder, which is a company that I really don't know much about, so I'm not going to get too deep into that one. I can't make a comment, in good conscience if I like it or not. Next, he's got a company they do have a word or two about, which is Nike, stock ticker NKE. Now, I think there's been some disrespect on Nike as a stock, and I'm here to clear the air. Nike as a stock is a very underrated stock. I think a lot of people have this bad stigma around it that it's bad because of its valuation, that it always trades high. Here's the thing. They have very high quality dividend growth, really great free cash flow growth, and looking at them as a company, they're a very strong company. They have probably the strongest brand in the world. Look at their pricing power. They can put their logo on a shoe that costs $20 to make and charge $400 for it, and people will buy it. It's crazy what Nike can do. Nike is also a very financially sound company as well. With that said, though, I unfortunately bought in there in the Nike highs in 2021 at $140, and right now it's trading near $105. With that said, I might look to add to my Nike position to get my cost per share down. With that said, looking at Nike, their PE is in the mid-30s right now, but looking historically, again, they trade very high. In all honesty, it doesn't look like a complete steal to buy right now. It looks like it's trading at a fair price, so don't completely count me out from adding to my Nike position. I missed the boat when Nike was trading last fall in the 80s and 90s. I probably should have added then. approaching this fall and winter, I'm going to be a lot more conservative with cash and hopefully have a little more capital if you guys hit that subscribe button for me right now. So if you want to help me get monetized, share the video with somebody, help me fuel my stock market addiction. Okay, on to the video, guys. I like Nike a lot though, very high quality company, and I think very highly of them. If it ever trades below 100, definitely will see me adding. And he's also got a small position in Pepsi. Now, you guys already know my thoughts on Pepsi. What a staple of a company. The only thing bad about it right now, I would really say, is payout ratio is a little on the higher side, as it historically kind of is with those companies. Also, it's a very high valuation right now. I don't think it's a buy whatsoever. With that said, though, it's of such a high quality company. Pepsi's got some of the highest quality brands in the world. It definitely places them over Coke in both the food and beverage sector. I think they're a great investment, though. I'd like to see them a bit cheaper. Alright, so let's go over the recap here. What are my thoughts on the portfolio? So it's a very high quality portfolio in general with a lot of dividend growth oriented positions, which is something I noticed, which I'm definitely not against. Joseph is a little on the older side, so maybe a little more yield could be appropriate, but I'm all in for this investing style, buying high quality compounding companies. I have no issue with any of Joseph's positions right now, really. I would like to possibly see him add maybe utilities. I would like to maybe hear some reasoning on that. I asked him about it, and I know he may not like to hear this, but maybe look at starting a small position in Altria, especially with what a smaller position in his portfolio is. I think Altria could do some serious good, especially at these prices. I think it offers a lot of value. Also, I think it could do Joseph a little good if he added maybe just a one or two more mature companies, possibly a Johnson & Johnson. And I also don't love how at times he does sell out of some companies. I understand it's great to take some gains, but for me, ideally, when I buy a company, I want to hold for 30 plus years. But again, me and Joseph are in different investing situations. Overall, I really do like Joseph's portfolio, guys. It's a very high quality portfolio. I'm going to give it an 8.8 out of 10. But again, thank you for Joseph for allowing me to go over his portfolio and actually being fine with showing real transparency. I think it's something that a lot more other finance creators need to really do. And I think it's nice that creators like me, Joseph, Dividendology, Dividend Data are actually showing our portfolios every month and promoting, a style of real man's investing. Alright, if you made it to this part of the video, really appreciate it. We're about to hit 1K, so there's going to be a question and answer, likely Thursday. From the bottom of my heart, thank you guys. We got a lot of big things coming. Alright, and of course, guys, thank you for watching. Hit that subscribe button, and of course, do dividend stocks, not drugs. Have a good one.